Oh, there's a bit of feedback. Henry, are you in twice, by the way? Hang on. Let's just make sure you're not in twice. That's fine. Okay. Good morning, everybody. Good morning, Barry. Good morning, Ron.
Morning.
Good morning, Fiona. If you could mute, that would be great. Just to cut out any background noise. That would be fantastic. Thank you. Oh, there's a bing. Let's see. Yeah. Elaine, I think I'm going to mute you. Morning, Elaine, but I'm going to mute you. It's a bit like Space Invaders. This is great. Yeah.
Welcome, Gareth.
Morning, Gareth. Yeah, that's very kind. Thanks. Morning, John. Mute. Yes, if you recently joined, if you could mute, that'd be great, just to cut out any background noise. As usual with Pension Playpen, we are recording. So Ron, Elaine, if you could confirm, Gareth, thumbs up that we are recording. We're all happy with that, which is great. And in our usual fashion, we want to ask if you have any questions to raise a hand. We always like the interactiveness of Pension Playpen. So we want to be innovative, and we want to be thought-provoking, and we want to get something out of this. And I think we're going to be touching on a few interesting subjects in today's session. So really delighted that I can introduce Adrian Balding alongside Henry. And so I think we'll wait another 30 seconds. But Andre, if you can monitor the lobby, that'd be great. We'll get cracking. So welcome everybody. Welcome to the session on are we offering pensions, or are we offering wealth management? I think this is quite close to Adrian's heart. Before we start, I would suggest that we all steer away from our microphones, because Adrian's got COVID, so hopefully you can't catch COVID through the mic. But I really appreciate our first presenter with formal COVID presenting to you today. And I'm sure it's not catching, but I wish you a speedy recovery, Adrian, and thank you for attending. So over to you, if I may.
Indeed. Thank you very much, Steve. I've got a few slides, so I'm just going to pop them on, and I'm hoping that you are happily seeing slides. If you're not, then object. So thank you very much all for coming and listening to me. We're talking about, are we offering pensions or wealth management? Now, for many years, I've been a bridge player. And I'm a member of a number of the bridge clubs in Surrey, and it's a bit of a cliche that bridge clubs are stuffed full of pensioners. But actually, as with all cliches, there's a degree of truth. So, I have met quite a lot of retired people over the years playing bridge against them. And almost always, they're very happy that they are in receipt of a pension from their former employer. And it leads them to having a life free of financial stress or financial distress. So those that get pensions are very happy. But obviously, primarily, those are people from the DB era. And now we're in a DC era, which is giving us a very different sort of picture. Just by way of backdrop, we do know that DC pensions are much less generous than DB pensions. So a piece of research that Dunstan Thomas published this year as part of their study of the baby boomer generation found that where baby boomers have a DB pension, that pension is providing 51% of their total retirement income. But where baby boomers have a DC pension, that pension plan is only providing 37% of their total retirement income. So we do know that against this backdrop of what are people doing with their money, if they're in DC plans, they are getting rather less in terms of retirement income out of them than if they were in DB plans. The numbers on the screen here are probably familiar to many of them. The FCA publish them from time to time. It's from their retirement income market data, and it's saying what are people doing at the point of retirement when they first come to vest a pension plan, to give it a technical term. And this is by numbers of cases. The vast majority of them, 55%, just simply cash it in. If you look at the data behind that, most of the people who cash the pension plan in go down to the building society and they deposit it in a traditional building society savings type account. Of the others, there's a few enough plus, quite a lot in drawdown, and just 10% of cases actually buy an annuity. So when we look at DC plans today, we can see that very few of them are actually getting any sort of regular retirement income that you might call a pension. Most of them, really are in the game of wealth management, and we concentrate very much on what funds are they in before retirement, and then with the fabled investment pathways, how do we get them in the right funds as they move towards retirement and then through retirement. So we seem to be providing very much wealth management rather than retirement income or pensions to them. I think the sad thing about this graph is it reminds us that we haven't seen much innovation yet. It's 8 years since the pension freedoms were announced, but we've had very little by way of innovation. There's been a bit. So Just Retirement have an annuity that you can now house inside a Flexi Access drawdown plan. And while they were doing that, they modernized the annuity a little bit as well. It's got things like surrender values attached to it that traditional annuities don't have. If it was a soap box that they were selling, for your washing machine, then they'd have slapped new improved all over the branding of it. But they're a little bit more staid than that because, of course, they're an FCA regulated firm. Coming over the hill in terms of innovation, we have CDC. And next year, we should see regulations from DWP that will enable a trust-based decumulation only CDC scheme to be created. So we should see something sort of new coming over the horizon there as an alternative for people who built up their pots of money in DC and are looking to see what can they spend it on at retirement. Not everybody is going to want to do CDC in a trust-based environment. And I know a number of insurers are talking to FCA about the possibility of doing a sort of version of tontines on that. But so there are some things coming, but at the moment we seem to be doing very much wealth management. What I wanted to think about was, are we actually meeting consumer needs as we go about, doing this? And I felt to do that, I wanted to look at 3 consumer needs. Do people need a fixed income? Do they need a spouse pension? Do they need inflation protection? And I find it helpful to sort of slice up the demographics into, I've chosen 3 slices. Minimum income, that's people who have got a pension of around about £10,000 a year. Comfortable, that's a pension of about £30,000 a year. If you're familiar with the Pensions and Lifetime Savings Association's retirement living standards, then you'll be familiar with those numbers. But also a category of wealthy people. Maybe my wealthy people are people that have sort of filled up their lifetime allowance and they've got about £1 million in their pension pot. So I ask first, do they need fixed income? And looking at these groups, I think down at the minimum end, it's strictly a personal choice. They don't need a fixed income because they're going to get nearly all of their income from the state system, either the basic state pension or some state benefits. And when you talk to these people, some of them still want to buy an annuity. They might owe me a little bit of money they've got in their pension plan, but they would like to have it as a regular income. And that's fine if they want that, but if they want to take it as cash, then take it as cash. And it's, I think, entirely something which they could choose. For my comfortable group, it's actually quite important that they have a fixed income, because if they don't, they have a severe danger of running out of money. Again, behind those FCA stats, we see that the average drawdown is 8% of the pot per annum. It won't last them for a lifetime if people go at that range. And so they will need a fixed income to avoid running out. And at the wealthy end, you would think, well, they're wealthy. They don't need the insurance against living too long that an annuity brings. But actually, surprisingly, if they put a bit of fixed term income into the mix, it really improves their outcomes. And I will come back to that in a minute, because I've got a slide that shows what happens for a wealthy person if they ditch a few of their boring corporate bonds and instead put a bit of annuity into the mix. My second thing is around, do people need a spouse pension? I think it's a bit immoral not to have one. So if you're buying an annuity, even if you're on minimum income, I would say, you really do need to look after your spouse from when you go. So you really ought to. Not essential, because again, the state pension will provide lots for them. For the comfortable group, absolutely essential. Otherwise, the spouse is going to be in terrible poverty. And for the wealthy, it's crucial that the spouse is included somewhere in the financial planning, but it doesn't necessarily need to be in terms of buying a retirement income for her. And then when I come to the question of inflation protection, for those on minimum income, no, they do not need inflation protection because they get most of their pension from the state, and their state benefits are inflation protected. For the comfortable, again, it's going to be essential because otherwise they will effectively run out. I worked in the annuity department of a large insurer in the 1980s and 1990s. And I dealt with customers that had bought a level annuity in the 1960s, and they'd been through the severely ravaging inflation of the 1970s. And they would ring up and say, why do I not increase their pension? I've been clearly increasing, bonuses for my with-profit customers. I've been giving, bonuses to the board. We've been giving pay rises to the staff of the insurer, but the poor pensioners got nothing because that was the deal they were on. But after they've been through that inflation, their pension was worth very, very little. And then in terms of my wealthy, well, there might be better ways to do it than buying their inflation protection up front. And that brings me on to one of the little examples that I've created and put together. I wrote this one up on LinkedIn, so it's on my blog on LinkedIn if you want to have a look at it. But I began to think about, supposing I was retiring today, and I was going to buy an annuity, should I buy for myself a level annuity or an RPI-linked annuity? And I popped onto Money Helper earlier in the month. I point out it is earlier in the month because obviously there's a lot's been happening in the markets since the middle of September. I used the Bank of England's inflation forecast, which shows that inflation will continue going up for a bit, and then it will peak and then it will come down and it will go back to their target. They think that will happen sometime in 2024. And of course, RPI will become CPI from 2030. That's the current government plan. They will continue to publish it as a separate index, but it will just go up at exactly the same rate as CPI and use the CPI methodology. So I took my £100,000 pot and I bought both a level annuity and an inflation-linked annuity. And I said, now what happens when I compare them? Obviously, the inflation-linked one starts at a much lower level, but then it builds up over the years. But I need to live to age 92 before the monthly payments under the inflation-linked annuity have actually caught up. And I need to live to age 117 before the total payments made from the RPI annuity have caught up with my level annuity. I did actually rerun these numbers this morning, and they're a little bit better. On today's numbers, which obviously sort of post the quasi-quartang, debacle in the markets, I only need to live to age 107 before the total payments from the RPI annuity have caught up with my level annuity. Now, I'm no Madame Jean Calvert, so I won't be buying an RPI-linked annuity. There are, I think, better ways that you can do it. One of the ways you can do it is to buy a level annuity with some of your money and then leave the rest of it in drawdown. And when you get good investment gains on the drawdown pot, bank those gains, turn them into cash, buy another bit of annuity, but again, buy a bit of level, annuity. Another way which is coming is CDC, and this is really quite exciting because CDC is going to offer inflation-linked target income, not guaranteed income, but inflation-linked target income. And what's interesting about inflation is that it significantly lengthens the tail of the liabilities. And interestingly, that's why these insurance-based products, the RPI-linked annuity, is so poor, because long-tail annuities, long-tail liabilities, they're like kryptonite. This sort of green sort of crystalline stuff. I brought a bit with me here. Much beloved by people that are not Superman. Superman doesn't like kryptonite, of course, and so in the same way, insurance companies do not like long-tail liabilities. And so they shy away from RPI-linked annuities, and they offer terrible, terrible rates, which is what you can get in the marketplace. CDC, on the other hand, is absolutely going to love kryptonite. So CDC is like a human being that gets superpowers when it gets hold of a bit of kryptonite. And so CDC will love offering inflation-protected liabilities, because CDC loves those very long tail liabilities. And it's one of the reasons why CDC is so different from the sort of insurance products we've been able to buy in the past. So I'm very optimistic that going forward, those who need some inflation protection from their retirement income will be able to get it from CDC. Now, I mentioned that if you're one of these wealthy people, adding a bit of fixed income improves your outcomes. And the slide that I brought along here is a simulation on a stochastic model that's been built by some very clever actuaries at Just Retirement. So the grey line shows that for somebody who bought at age 70 they retired at age 70, they had a pot. As they take some money out of the pot, it gradually diminishes. And that's a sort of classic picture for somebody working their way through a drawdown pot. And the grey line is the median line out of the 1,000 or so simulations that just ran. The green line says, instead of going drawdown, and that drawdown portfolio had a classic sort of 60-40 equity bond split, take 15% of those bonds and use them to buy an annuity. And what you get as a result of that is that the value of the fund, the residual value were you to die at any point, is initially less because you bought some annuity and its death benefit is not as generous as its purchase price. But actually, it lasts longer. And you get this crossover at age 82, which is 12 years into the mix. And if you live beyond that, then this portfolio, which has ditched some of those dull bonds and replaced them with a bit of guaranteed income from an insurance company, actually performs much better and delivers much better outcomes. You can take those outcomes in any of three different ways. So you could say, I'm going to have the same retirement income, but I just feel comfortable now that I've got a rather lower risk of running out. You could take the same retirement income and say, I'm rather delighted that I'm going to have a higher residual fund when I die. So there'll be more to leave for my heirs. Or you could say, I'm happy with my risk of running out, so I'm going to leave that the same, but I can take a higher income every month for the same risk of running out. So you can take those improved outcomes in any of three different ways. Now, there's just one more area that I wanted to cover before we, break for questions and I introduce you to my glamorous assistant today. And I want to talk about the model that, two brilliant partners at LCP, Steve Webb and Philip Boyle, I think they've been on Pension Playpen and sort of shared their wares and explained what they've been doing. They built a brilliant model around when should you buy an annuity, which they said they wanted to start a conversation around the merits of delaying annuity purchase. So I thought I would just introduce a little contribution from my own into the conversation. And inspired by the earlier work that I'd done with Money Helper and asking for different annuity quotes, I thought, let's go on to Money Helper and ask for a couple more quotes. So firstly, I've asked for a level annuity today. What do I get if I get a level annuity today? £100,000 pot. And I actually did this yesterday. So this is sort of post quasi-quartang numbers, which is why they're a bit more generous, I think. A level annuity at the moment for my £100,000 pot, I get £525 a month. That's thank you, Canada Life, who are the best in the market today. If I was 10 years older, so I went onto the same portal, apologies, crossed my fingers behind my back and pretended that myself and the wife were 10 years older, then the quote comes back at £635 a month for the £100,000 pot. Or alternatively, you could say I'd only need to buy £82,677 into the annuity pot to generate that same £525 a month. So the question that I asked myself is, what return would I need to do? What return would I need to get on a drawdown pot? If I put that £100,000 pot into drawdown, but took off the £525 a month that I could have earned for an annuity. And I do that for 10 years, and then I make sure I've still got £82,677 in 10 years' time in my pot to buy an annuity with. What is the return I would need? And the answer is just over 5%. Of course, I've got to pay for platform charges and stuff on top of that. So I've probably got to earn just over 6% on my assets. So, apologies, to sort of bring it to a conclusion.
Are you okay, Adrian? I think you're struggling to speak there, but I've got a question. Maybe Henry, you could answer this question, Henry. What do you think of this concept then of delaying and keeping the money invested, getting that 5 or 6% return, and then buying the annuity later? What do you think of that concept, Henry?
Well, I mean, the key thing, and we all are waiting the heroic return of Adrian to back this up. But the key thing that Steve says is that happiness is increased by annuities as you get older. So somebody buying an annuity at 60 isn't getting the same kind of happiness from making that purchase as somebody who buys an annuity at 80. And that's their big breakthrough moment. It's a heuristic, it's a behavioral thing. I agree. I mean, that touches myself, makes me and makes sense to me intuitively. And I think most people have agreed on that. So there's an awful lot of sense in what Steve says and Phil says. My problem with all of these things is pre-programming a system till you buy the annuity at your 80th birthday or whatever, although it makes sense, has got problems about it. Yeah, not least that people change their mind, they have second thoughts, or they simply get to 80 and they go, goodness, should I wait or should I not? And they're a little bit knocked up mentally, and then they worry. Yeah, so it's kind of, it would be nicer if they could take that decision at the outset and get a guaranteed rate. But we all know you can't do that because the deferred annuity rates are so problematic. They're even more problematic than these RPI rates, which Adrian's been talking about. There's not enough demand in the market to get a proper market on these things. So the alternative, which Adrian is talking about, is actually buying some annuity now and using drawdown, and that mix, yeah, can actually create better outcomes. And I've heard him say this before, and clearly, if you feel that 6% is a return which you could achieve on your drawdown long term, then that might well be a very good solution for you. If you're like me, 60, and you've got a decent sized pot and you want to maximize the utility of it. Now, here is our heroic soldier back on our screen. He's sort of smiling, but I'm not quite sure
back.
whether we
Thank
are
you.
actually doing
Apologies, the voice is so. Yeah.
Anyway, I was characterizing what. Did you hear what I said, Adrian?
Hmm.
And was I roughly saying the kind of things that you would expect somebody to react to your spiel with? You know, was I?
Yes, I think so.
Response?
I mean, I think the interesting thing about deferred annuities is, of course, that they are a guarantee, in much the same way that the a conventional annuity is a guarantee. And guarantees have to have reserves behind them.
Mm-hmm.
So if an insurance company issues an annuity or a deferred annuity, it must have to put reserves behind them. Reserves are more substantial for deferred annuities, again, because the guarantee is longer. The reserves are shareholder money. And if you dig into the accounts of an insurance company and you wake your way through all that fine print that they put, you eventually get to the point where they tell you what rate of return they're earning on the shareholder money. And for the big insurers, the big ones on the FTSE 100, they're earning in the region of 15, 16, 17% per annum on their shareholder money. So if I buy an annuity from them, part of my annuity payment has to go to keeping up this huge 15, 16, 17% return that the insurance company's shareholders want on their money. It costs the annuitant a lot of money to support the insurance company shareholders. And that's the function of guarantees and the cost of the guarantees. The benefit the annuitant gets out of it is the cast iron guarantee. When we move instead to CDC as an alternative, the CDC comes with no guarantee at all, other than it will last to the end of your life. But we don't know what it will pay. It's targeting to pay the initial rate of benefit increased by cost of living every year. If you're in the Royal Mail scheme, I think they're actually targeting slightly over CPI. I think they're targeting CPI plus 1. But there are others that are much better able to speak about Royal Mail than I am. But there's no guarantee. It may pay lower increases than that. It might pay higher increases than that. It may pay reductions some years. So the trade-off is that. But the quid pro quo of that is the CDC scheme has no reserves. The model that DWP have gone for is a model which has got zero reserves in terms of member benefit. The only reserves that you'll find it's holding are enough reserves in terms of the administration costs, exactly the same way that a master trust offering pensions today has to hold reserves for its administration cost, so that if the scheme gets into trouble, it's got enough money to wind itself up, find somewhere to transfer the members to, and to do that in an orderly manner. But those are just administration reserves. It's not holding any of the financial reserves that an insurance company holds to make sure the insurance company can pay the benefits. So it doesn't have to finance those reserves. And that's one of the reasons why, when you look at the academic papers on CDC, it's promising pensions 30%, 40% higher than conventional DC plus annuity. One of the big reasons it's able to do that is because it hasn't got these reserves, so it isn't having to fund the insurance company shareholders.
Which is a beautiful explanation of why many insurers have been very adamantly against CDC so far. It's not quite such a profitable business for an insurer running an investment proposition. So take Legal & General, Adrian's former company. If you look at Legal & General's accounts last year, you will find that they have been making stonking profits on their annuity books, both the individual and the group annuity books, and making profits on all kinds of other activities like equity release and so on. The only area of their life business where they aren't actually making any money is their asset management business, LGIM, which is very low margin, and that's because they have to pay people a lot to compete for that sort of kind of business, and they aren't able to take very much out of it because of various caps and so on. So Nigel Wilson, in his infinite wisdom, right, always tells me that as an insurer, the last thing he wants to be is purely an asset manager. And Adrian's nodding there because he knows Nigel Wilson very much better than I do.
Super chap,
yeah,
yes.
And there's nothing wrong in insurers wanting to be insurers. Yeah, that's what they're there for. Yeah, and they do a bloody good job of it in this country. But as far as us consumers are concerned, my guess is that a lot of us can't afford the kind of insurance which we're talking about, because we have to pay for it in the annuity rates. And one way I think of considering CDC is an annuity without insurance, where effectively in a decumulation situation, somebody like me, 60, £500,000 worth of DC, I can get probably an annuity right now of say 25 grand. I would be able to get a CDC annuity without the insurance of say 35 grand, and I'd be prepared to take my chances. Yeah, I would certainly want the choice if it was available to me. Sorry, as the glamorous assistant, I'm probably going on a bit, but I am actually a bit concerned that after 5 years since the Royal Mail actually said they were going CDC, yeah, we discovered yesterday, when we spoke to the pension regulator, but not a single CDC application has been made. Would you believe it, Adrian? Here we are 2 months after August the 1st, when the applications were due in, and Royal Mail still haven't got their bloody application in. So
I don't have any difficulty believing that, Henry, because I had the joy of working at Now Pensions while Now Pensions was working its way through Master Trust authorization.
Yeah.
And as I'm sure there are others on the call that also grapple with Master Trust authorization, it's a huge project and an enormous task. And we literally had to compile, a lorry load of papers and send them all the way down the motorway.
You didn't have a 5-year run-up, Adrian. I mean, 5-year run-up. So anyway, there we are. It's going to take, my point is, it's taking a bit longer to get this CDC stuff over the line than I hoped.
Yes.
Well, actually, Henry, the point you're making is individual CDC. Can that work in the space Adrian's talking about? Is this what we're talking about, Adrian? Because the consumer doesn't have to pay for the hidden profitability that the shareholders want. That's what you're saying, Adrian, yeah?
Now yes. So I think
the whole DWP thing, sorry, I'm being really rude now and cutting across you, Adrian, but the whole DWP thing seems to be that CDC is a scheme, yeah? And I don't think it needs to be a scheme. I think you can consolidate using a fund rather than a scheme.
Who's the provider, Henry? Who's the provider then? Who's the provider in that?
Well, we talked about we had him on our call, Mark Johnson. There's a fund that's self-annuitizing, no insurance company. The only issue with insurance is it's inside of a pooled fund, but that's just a wrapper. And it's an insurance company administration unit doing the annuitization and the underwriting and stuff like that. So that's about as much involvement as insurance is concerned. All this reserving stuff that Adrian is concerned with, not there. Yeah. Therefore, rates 25-30% above the guaranteed rate because there's no insurance company standing behind what's going on. It's self-annuitizing in the fund. And that's what Adrian was referring to when he said a tontine. It's what we call a modern tontine. It means it doesn't wind up. It's open-ended tontine. Yeah. So new people arrive all the time and people die. And your expiring people are basically paying the rate for the new people joining in. It's not an intergenerational transfer unless we get massive differences between the number of people going in and going out. So sorry, that's me shut up. That's my glamorous assistant bit sorted out. And we've got
Adrian, how do you want to respond? Yeah, go on that. Yeah,
well, I'm looking forward to choice. So I'm looking forward to when we get to the point, and I think it'll be 2024 when we get there, that when somebody who's about to retire goes to PensionWise, whereas today PensionWise say to them, look, assuming you don't want to cash it all in, you want an income, you can either have an annuity or you can have drawdown. From 2024, I think they'll say you can either have an annuity or drawdown or CDC.
Absolutely.
And that's really, really exciting. That's where we want to get there. Now, it is possible that within that CDC classification, there might be two different forms of CDC. There may be a trust-based form, which is, under DWP legislation, regulated by TPR. And DWP and TPR are well on the road to creating that. The primary legislation is through Parliament and passed. The secondary is going to be consulted on next year. So realistically, we could have a trust-based CDC Act decumulation in 2024. What Henry's talking about is another form of choice, which we might also manage to get, which will be a sort of FCA regulated version of it. And we have things that exist in the marketplace today. So if you're an employer in workplace, you might consider whether you wanted a GPP under FCA regulation, or whether you wanted a master trust under TPR regulation. And indeed, some of the big insurers offer you both and say, which do you want? They look the same, but they got different regulation. So it is possible that we may get to an FCA regulated version of CDC as well. I think there are two particular difficulties that we need to overcome to get there. The first is around the law concerning tontines. And some people will tell you that tontines are illegal. They're not actually quite true. They're not illegal. What is illegal in this requirement is where many tontines fail. There's an antiquated piece of legislation called the Insurance Act of 1770. So when you construct your modern day tontine, you've got to make completely certain that you're sitting on the legal side of Insurance Act 1770. And I know that the insurers,
one where you weren't allowed to go around killing all the other people in the group, so you cleaned up. That was the moral hazard, wasn't it? Yeah.
Absolutely, yes. So, you know, if all the shareholders of Age Wage decide to form a tontine and say that the last one alive becomes the sole shareholder of Age Wage, then that'd be illegal, because, as Henry said, we'd all be going around, you know, the first thing I'd do is cut my glamorous assistant in half, and that'd be him out of the way. So, so that's the first thing the insurer will need to do, is to make sure they're on the right side of the legislation. Because if you're not on the right side of the legislation, the thing will unwind later with great pain. And then the second thing to do is, and this is trickier, will be to ensure that the other people in the group have a stronger legal claim to the pot than the widow. Because what is going to happen when the insurer sets one of these things up is, sure as eggs is eggs, there's going to be a case where somebody dies leaving an impoverished widow behind them. And the impoverished widow will rock up at the insurer and say, I need money. I have a stronger moral claim to this money than those other people in this insurance fund that have absolutely no knowledge of my husband and so forth, and they don't need money because they're wealthy. And it'll go to the ombudsman, and the ombudsman will make a ruling. So there's a big piece of legal work to be done in the construct of this thing to make sure that it really can be completely bulletproof and withstand the future claims of the impoverished widows that will turn up and try and wreck the thing, because they'll say they need the money.
Adrian, sorry to butt in, isn't there putting my consumer hat on, isn't there a middle ground there? Could there still be generous rates for the remaining members, but also something for the spouse as well? Because it's a rule, you just create a rule and say that's the rule. There's a sharing on death instead. I mean, are we saying it's one or a binary, 1 or a 0?
Well, that's a very interesting question that you raised, Steve, because if you look at DB schemes, if you're fortunate enough to be in a DB scheme and you're married at retirement and you set into retirement life together and you die before your spouse, then your spouse automatically inherits, and they will get a spouse's pension because DB schemes provide one. If you're in a DC scheme, then it's done that you get to retirement age and you buy an annuity, and the member chooses as to whether they buy a joint life annuity or a single life annuity. And in some cases, the member looks at both, they realize that the single life one's going to pay them something like 20% more. They can't afford the lower income, so they buy the single life annuity, but they tell her indoors that they bought a joint life one because they know that by the time her indoors finds out, they'll be gone. And the legal construct of an annuity is so strong that it is unbreakable. And when, as an insurer, you get into this situation and, the spouse turns up and says, surely there's a widow's pension attached to my husband's annuity, you can say no to them. I think the tontine thing, it's a big piece of work to be done to create a construct that is sufficiently strong that it can withstand a widow turning up and saying, I don't want my pot to pass to those other people. I want it to pass to me.
We want blockchain to say no. We need some
but your point, Steve, is could you create the thing to say there is no choice for the member? They have to have a widow's pension. I think it'd be much easier to do that in the trust-based environment. So I think we will find that the trust-based CDC schemes, when they're going through their scheme design stage, they will wrestle with this and they will come to a conclusion as to whether for their particular scheme it's right to have a mandatory spouse pension or not. I believe the Royal Mail have decided on having a spouse pension, but I'm not 100% certain of that, and I can't speak for the Royal Mail.
Your language is very much cast in the past. You talk about spouses, and it's now much more partner-based, isn't it? So we're going to have all kinds of arguments about classes of partnership. And you've got further complexity about whether or not you're actually living with that person, or whether that person's just arrived in your life at the last moment, hoping to pick up whatever. So
which again leads us to saying this is some of the advantages of the trust-based situation.
Yeah, because the
trustees tend to have the discretion and they are able to do this. I had a very stressful case when I was a trustee of a member of staff at L&G that I knew well. He died early, and he left a wife, but he was not living with the wife. The wife thought that he was a lodger in the flat that was owned by another woman. In fact, it turned out he was a bit more than a lodger, and indeed the other woman had become financially dependent upon him. So we were able to use our discretion as trustees to come up with an appropriate share of the death benefits between the wife that he was married to but no longer living with, and the other woman that he was a bit more than lodging with.
Well, the conversation's taken an interesting turn, and I can go on with similar stories regarding the actual one case, but I won't because there are lots of great stories about these things. But coming back to the central part of your presentation, it seems to me now that the old Dunstan Thomas option, which was buy some annuity and buy a bit of fixed income, is still very much front of action for you. But the Steve Webb flex now, fix later idea is very much in play, and that the third idea of the CDC style annuity, which is what I'm calling it, but probably that's the wrong word because somebody's going to jump on me and say annuity implies the wrong thing, is also in play. Would you say that's a fair estimate of where you see the market moving?
What intrigues me about the the Steve Webb idea, that the flex first, fix later, is that you've moved the decision point to buy an annuity some way down the road. It's never an easy decision to buy an annuity because you are writing a very big check and handing a very large sum of money over to an insurance company. It's not an easy thing to do. So the question that I have on that is, does it become easier to do that as you go through your retirement life, or does it become more difficult? Will it be easier for me to write this check and hand it over when I'm age 75 than when I'm age 65? And I don't totally know the answer to that. I mean, a very good point that Steve pointed out was obviously when you get to age 75, the annuity rate is better. So you seem to be getting more per month for your money. Maybe that helps. On the other hand, you are getting closer to death, and the closer you get to death, the more interest the rest of the family take in the matter, noting that if you've turned it all into an annuity, they don't get anything on your death, whereas if you went down drawdown, then they get quite a lot on your death. It's a bit like the people who buy an annuity very, very late in life, because they're buying one of these care annuities. A good friend of mine put her mother into a care home and had a huge debate with mother and the rest of the family about whether they would buy, one of these annuities for care home fees. The calculation showed that mother needed to live for 3 years or longer in order for them to break even and make a profit out of it. They thought, no, the old dear's very unsteady on her pin. She's never going to live that long. So they didn't buy it because they didn't want to lose so much of their inheritance. In fact, mother went on for 5 years, not 3 years in the care home. So with hindsight, yes, it would have been better to have bought the care fees annuity. I actually think it becomes more difficult the older you get to make that decision to buy the annuity. So there's a little bit of sort of kicking the can down the road going on in the flex first, fix later idea, and I think it might be making life more difficult for people in the future.
Yeah, I'm with you.
I agree. Yeah.
Now we've got
and also,
Gareth, you want to have a word?
Gareth, you've got a hand up. Yeah.
Thanks. Yeah, I actually wanted just to pick up a couple of things right back at the beginning of what Adrian was saying. I'm not, as I think many of you know, at the kind of the wealth management end of any of this kind of understanding, let alone involvement. And I will say in passing that I do wish people would stop talking about wealth when they talk about pensions, because it turns off an enormous number of people who see references to wealth and think that is not for me. Whatever they're talking about, it's nothing to do with me. I also hope that Adrian's right when he mentioned in passing that means tested benefits are okay because they're inflation proofed, thanks to the way that uprating happens. We'll find out more about that in the next couple of weeks. But it was really just a passing comment that Adrian made that I wanted to pick up on. He said at one point about lower kind of income people there, that it was fine by him whether they chose a regular income or capital. It didn't make much difference. And in actual fact, it does make a huge difference to people who are reliant on any kind of means tested state benefits. The great thing about pension freedoms from that perspective was that it stopped people having compulsory annuitization, because annuities come penny for penny off any benefits entitlement by means testing that you have. And an enormous number of people with very small kind of DC pots and quite often, not that huge a benefit entitlement, never saw a penny gain from those annuities because it just reduced the amount of benefit they were getting. And the difference between taking income and taking capital it can be enormous. You may be very, very much better off by taking drawdown irregularly than you are by taking income. And it just worries me that Adrian, who I have learned an awful lot from over the years, just made that kind of passing comment as if it's something that he was either unaware of or that didn't really matter.
Gareth, I think those are very, very sensible comments, and you are quite right. I have glossed over the issue of means tested benefits, and many of those on low income might be eligible for means tested benefits, and those eligible may or may not claim, and they may be on means tested benefits, or they may not. Something that Henry knows well, many people eligible for them don't actually want to claim them for various reasons.
Well, you've got that 55% of people cash out before they get to state pension age, and a good few of those people will have been doing that quite deliberately, knowing damn well that having the money in their pension account might well disqualify them from pension credit.
So yes, I fully agree with that, and Gareth, you're spot on. I did think the pension credit had a taper, so I didn't actually think you lost pound for pound. I thought if you're eligible for pension credit, then you lost at 40p in the pound. But I remember when Alistair Darling introduced pension credits, he was very, very proud that it had a taper on it. But the taper is just smoothing the effect. It doesn't disguise the effect that, yes, if you've got some of your own money, then you may get less by way of means tested benefits. If it's an annuity that you bought, so you bought a fixed income, then that will go into your calculation as your available income to see whether you're eligible for benefits. If you've got savings, then a assumed rate of interest is made on those savings. So again, to follow Henry's thing, if they cashed out their pot, then potentially they need to declare that, and an assumed rate of interest, which the DWP will tell you is not really a rate of interest, it's a rate of spending it. You won't get that much interest out of the bank account, but they assume that you get some interest and you spend some of it down. So you might find that you're caught out both ways, but if you turned it into a drawdown pot and you take it from time to time, maybe you can shelter more of it that way.
Yeah, in fact, there are two very different kinds of. There's a notional income, which is effectively 20% notional interest for money held as capital, but money held within pension savings is different. That generates a different kind of notional income based on the 15-year gilt rates. And in fact, that means that people who've got untaken DC savings have seen the notional income from those shooting up over the past month because the gilt rates effect hits them, and very, very substantially reducing their benefits.
Yeah.
Not a lot of people know that, but if you follow Gareth, you do. It's one of the benefits of being on this damn call. Right. I had a couple of things which I thought came across very, very strongly from what you said, Adrian, and I wanted just to ask you about them. You were saying that if you were going to take an annuity and you were going to have some of your money in drawdown, you would probably get better outcomes if you live beyond 82. Yeah. And you were looking there at a typical, I think, 60-40 portfolio. Yeah. Have you thought about whether or not you could actually go further than that and leverage up your well, not leverage up, but just say take 100% in equities, put more into bonds, and would that be better? Is there an efficient frontier developing between these two things? And are annuities effectively a pleasing substitute for bonds in a balanced portfolio at retirement?
Oh, that's a very good question, Henry. And of course, your IFA will be using a tool to firstly assess what is the risk tolerance of his client, and then secondly to assess the risk inherent in the particular fund that you're invested in. So clearly, in creating that 60-40 portfolio, that's probably for a client that was assessed as medium risk. They know that the equity part is high risk, the bond part is low risk, and the risk engine they're using has told them that a 60-40 split will give them a portfolio appropriate for a medium risk person. So what just did in that simulation was to say we're going to put 15% of the money into an annuity that is low risk, and they then resplit the rest of the fund, which then becomes a 70-30 split,
yes,
in order to create the same risk for the client, because it's important that the IFA can demonstrate to FCA that they've got the right risk mix for the client. One of the difficulties that Just have encountered in this is that a number of the proprietary risk engines on the market doesn't recognize annuity. You and I see annuity and we say, oh, that's low risk. If they're doing risk on the scale of 0 to 10, we'll score that as 0. Some of them struggled to recognize annuity. Some of them were based more on an old-fashioned wealth management thought, which is looking at volatility of asset values, and said, if you bought an annuity and you then die outside of the guarantee period, it's worth nothing. Therefore, it's super risky, and they were trying to score the annuities up at the high end of the risk thing. So Just have been working very hard with the various tool makers in the market that produce these tools to educate them and to help them to bring annuity into the mix of their tools so they can properly recognize that it is in fact a very low risk item. I think it's considerably lower risk than bonds, because bonds can default. If you put your money into a bond for a company that goes bust, it defaults. Annuities can't default. You put your money into an annuity, the insurer is obliged to pay you that for the rest of your life. And in the almost unforeseeable idea that an insurer itself went bust, the Financial Services Compensation Scheme covers annuities at 100% with no offsets for the entire remainder life of the individual. It's an incredibly generous guarantee that FSCS put in underneath annuity. So it really is a sort of zero on your 0 to 10 risk scale.
That's really
I haven't really answered your question, I think, which was to say, could I up the equity portfolio even further? And if I up the equity portfolio further, then I will expect to get better outcomes. But I must understand that my spread of outcomes will become wider. And that, therefore, is a higher risk activity. And so unless the IFA is able to say, actually, my client isn't really a medium risk, they're a medium to high risk, I could put them up, then, that's the way they'd have to work through that. I do actually happen to think that IFAs quite often get the risk spread wrong. I had a good friend come to me and say to me, could you explain to me what this IFA has done for me? And we went and looked through it all, and I said, do you know they've assessed you as low risk? Even though she had a stable job and she had a skill set that would have enabled her to go and get fresh employment in the same field, even if her own employer fell over. So I persuaded her to go back to the IFA, explain that, and say perhaps I could be medium risk, not low risk. And that duly happened, and the IFA, you know, increased the risk and gave her a bit more growth. And I think she's done much better since.
Okay. Steve, we're 3 or 4 minutes away from the end of our allotted hour.
Yeah, I wanted to, number one, thank Adrian for his fantastic presentation and your input, Henry, as well. And you're the first presenter, Adrian, to present with COVID. So
my apologies for coughing. I feel terribly guilty for inflicting that on you. But
hopefully none of us will catch it. But it was a great presentation and thought-provoking. You know, there's a lot of stuff in the industry. And we as an industry and we as a network, Playpen, need to keep pushing these themes and these ideas, because we want to shape the products of 2024, 2025, 2026, better outcomes for members and consumers. That's what it's all about. So innovation is the key. I know he's gone now, but this is what Guy Opperman wanted, the industry to be innovative, and we all collectively can discuss, debate and innovate, and through our own connections can you know, try and push these themes through, which is fantastic, Adrian. So really appreciate that. I have got Aaron on the call, Aaron Mouse, who's main assistant sort of head on Playpen. Aaron, do you just want to go through the CPD? We've just introduced CPD. Can you just go through with the members that are on here how that actually works going forward?
Sure. Thanks, Steve, and thanks, Adrian, for the presentation. So as you may have seen from the emails we've been sending out, we've now started a small fee for using Pension Playpen, which will allow you to attend the coffee mornings. It's £25 a month or £250 for the year, so a cup of coffee per week. And to attend the meetings, you simply go to the events page, click on the event, and you will click attend, which will then reveal the link to the event. And by clicking attend, you will automatically then receive a certificate for a CPD for the event. So again, in order to attend the event, you now need to be a premium member. And in order to get your CPD certificate, all you need to do is click attend on the event page. You'll reveal the link and automatically receive your CPD certificate.
That's great. And there is an option for free members to buy individual tickets to individual events as well. And they will get a CPD if they click the same box, I presume.
Indeed, yeah. If you click, if you purchase an individual ticket, again, you'll get access to the event page, which will then be the same system as clicking attend, revealing the link and getting the CPD automatically.
Fantastic. And obviously, if anybody has any questions about that, then you can email us at support@pensionplaypen.com. So, you know, that's the next step. And obviously, you know, we are very passionate about pensions and very passionate about developing and ideas and innovation. So it's really important that we keep the momentum going. On that theme, some of you may have seen Dr. Con Keating's blog regarding Anatomy of a Crisis. He's got the highest blog views ever of 184, I think, which was fantastic. So congratulations to Dr. Keating. He's agreed to present next Tuesday a further coffee morning to discuss that very theme, the impact of the markets, the impact on DB, the impact on funding, the impact on LDI. I think it'd be a fantastic coffee morning to attend. And he's got some great thoughts, and he may even ask Professor Clatcher to join as well. So that'd be great. So next week will be Anatomy of a Crisis, talking about the markets and what the hell's going on. For today, I want to thank Adrian so much for presenting. That's really appreciative. And Henry, the glamorous assistant, we will send a sword or a saw and chop you in half next time, Henry, if we can. But that was fantastic. Thank you very much. And I wish everybody a peaceful and pleasurable day. And as we always say, let's pray for peace in the East. So let's crack on. And fantastic presentation, Adrian. Thank you very much. And enjoy the rest of your day. And if you've got any questions, don't forget email support@pensionplaypen.com, and we can sort out your CPD certificate if you don't get it for whatever reason. And if you like Playpen, please share with other friends, invite friends on the Invite Friends tab, and let's continue the momentum on that. So thanks so much indeed for everybody's time today, and hope you enjoyed it. Thanks very much indeed. Take care. Bye.
Cheers.